The 4 worst market crashes in the history of the U.S. stock market. The U.S. stock market has experienced some of the most dramatic market crashes in history. From the Great Depression to the bursting of the dot-com bubble, there have been several events that have caused significant losses to investors over the years. In this video, we'll be looking at worst market crashes in the history of the U.S. stock market and what caused them. By understanding the root causes of these crashes, we can gain insights into how to protect ourselves from similar events in the future. So let's dive in and explore the 5 worst stock market crashes in U.S. history. 1. The crash of 1929. The crash of 1929 is often cited as the worst market crash in the history of the U.S. stock market. It began on October 24, 1929, a date which has since become known as Black Tuesday. On that day, the Dow Jones Industrial Average, DJIA, dropped 11.7%, and it continued to fall in the following weeks. By November 13th, the DJIA had dropped 25%. The primary cause of the crash of 1929 was excessive speculation and margin buying. During the late 1920s, stock prices had risen to unprecedented heights, despite weak underlying economic fundamentals. People speculated by investing heavily on margin, borrowing money to invest in stocks, and this drove up stock prices even further. As these speculators began to panic, they started selling their stocks, leading to an avalanche of sell orders that caused stock prices to plummet. The effects of the crash of 1929 were devastating and long-lasting. By 1932, the DJIA had lost over 89% of its value, wiping out nearly $89 billion in wealth. This crash set off a chain reaction that eventually led to the Great Depression, the worst economic crisis in American history. The reverberations of the crash of 1929 were felt worldwide, and the global economy did not fully recover until World War II. 2. The dot-com bubble burst. The dot-com bubble burst was a period of economic decline in the U.S. stock market between 1999 and 2000. The term dot-com refers to the dot-com companies that were booming during this time, such as Amazon and Yahoo. During this period, the technology-heavy NASDAQ Composite Index experienced tremendous growth, and many investors poured their money into these risky investments to make quick profits. Unfortunately, when the bubble burst, this growth came to a sudden stop. Many dot-com companies declared bankruptcy, causing investors to lose billions of dollars overnight. The S&P 500, Dow Jones Industrial Average, and NASDAQ Composite all dropped significantly, with the NASDAQ declining by 78% in less than 2 years. The collapse of the dot-com bubble can be attributed to several factors, including overvalued stock prices and speculative investing. Many stocks traded at prices far beyond their true value, and without any fundamentals to back them up, so it was only a matter of time before the bubble burst. Additionally, many investors had adopted a buy now, ask questions later mentality, which led to reckless investing and exacerbated the crash. Despite the devastation caused by the dot-com bubble burst, some positive outcomes emerged from it. For example, investors now have a better understanding of risk management, making them more cautious when investing. Companies are also now required to adhere to stricter accounting regulations to protect against similar crashes in the future. Finally, the internet and technology industries have become more efficient and innovative, leading to the development of new products and services that are used by people around the world every day. 3. The subprime mortgage crisis. The subprime mortgage crisis of 2008 was a catastrophic event in the history of the U.S. stock market. It was caused by a combination of factors, including reckless lending practices and an overextended housing market. In short, lenders approved mortgages to borrowers who were unlikely to be able to repay them. When this cycle of bad lending became unsustainable, the entire system crashed. This caused the housing market to spiral downward, with home values dropping significantly and foreclosure rates skyrocketing. Banks were unable to recover their investments, leading to a widespread financial crisis. The stock market felt the effects of the subprime mortgage crisis, with the Dow Jones Industrial Average dropping dramatically from 14,164 on October 9 2007 to 6,594 by March 2009. This was the largest single-day point drop in history and marked the beginning of the worst bear market since the Great Depression. The subprime mortgage crisis had devastating economic consequences that are still felt today. It caused a significant rise in unemployment, as well as an increase in poverty levels and wealth inequality. Many investors also lost their life savings due to risky investments and insufficient regulation. Ultimately, it is estimated that the total cost of the crisis was over $20 trillion. The long-term damage caused by the crisis cannot be understated, and it serves as a reminder of the importance of proper regulation and risk management in the stock market. 4. COVID-19. The most recent market crash to rock the United States stock market was caused by the coronavirus pandemic of 2020. The economic shutdown due to social distancing and other virus-related measures led to a rapid plunge in stock prices throughout the country, starting in late February and continuing into March. This resulted in a record-breaking drop of nearly 12% on March 16th, with the Dow Jones Industrial Average falling more than 2,000 points in a single day. The losses accumulated over the entire month of March added up to more than 20%, which was the largest monthly drop since 1987. The S&P 500, NASDAQ Composite, and Russell 2000 indexes were all down at least 22%. This also marked the fastest ever bear market, taking only 16 days for the S&P 500 to fall into a bear market, down 20% from its peak. Although the markets have been volatile, they have been recovering since mid-March as governments around the world began introducing massive stimulus packages to soften the blow of the economic shock. Despite this progress, the coronavirus continues to cast a dark cloud over the economy, and it remains to be seen how long the markets will take to fully recover. Impact of these major U.S. stock market crashes in the world. The U.S. stock market has had a profound impact on the world economy and financial markets over the years. From the Great Depression in 1929 to the dot-com bubble burst and subprime mortgage crisis, these major market crashes have shaped the way we look at investments and how we manage our money. When the U.S. stock market crashed in 1929, it had a ripple effect across the globe, leading to a global economic depression. As economies around the world suffered, businesses were forced to downsize, unemployment increased, and wages decreased. Banks collapsed and governments attempted to stabilize their economies with stimulus packages. The dot-com bubble burst of 2000 brought a deep recession in the U.S. The fall of the stock market in 2000 resulted in massive job losses and sent technology stocks into a tailspin, leading to the collapse of many internet companies. The fall of tech companies also resulted in a decrease in venture capital investments and startup funding for many years. The 2008 subprime mortgage crisis caused massive disruptions in the global financial system as many banks were bailed out by governments around the world. This crisis led to a severe recession that sent unemployment rates to record highs and pushed millions of people into poverty. The crisis also caused a credit crunch that made it difficult for businesses to get loans from banks and other financial institutions, leading to further economic stagnation. The COVID-19 pandemic has had an unprecedented impact on the global economy and financial markets. Governments have implemented unprecedented measures such as travel bans, business shutdowns, and stay-at-home orders, resulting in a dramatic decline in economic activity. This has caused a significant decrease in demand for goods and services, leading to plummeting stock prices. These major U.S. stock market crashes have had a huge impact on the world economy, leading to economic recessions and depressions, job losses, and a decrease in venture capital investments. The U.S. markets have the power to shape global markets and economies. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.